So, housekeeping detail, please, everyone remember to turn your mic on when you speak and then turn it off with the red button. And then we have two folks who are new to this panel, and I would let them introduce themselves.
Thank you, Bob. Richie Prager, BlackRock.
Jim Harshaw, GM Pension.
So we're now going to talk about the advantages and disadvantages of the different models, and most importantly, the advantages and disadvantages of the models compared to each other. And so one of the things that was sort of alluded to earlier, and I'd like to raise it here now, is what are the differences, if any, between swaps and that industry and the both cleared and uncleared, and the futures markets that are relevant to this discussion?
Start, Bob? I mean, I think we heard some of it in the prior panel, and I think it's a great question to start with to sort of frame just some broad differences. So when we look at the OTC market and the swap market and look at some of the statistics published by ISDA, my understanding is some 600 trillion notional outstanding. We have today, I think in the cleared space, some 200 trillion of which is cleared primarily on LCH in a dealer-to-dealer environment. So that's one metric. I think if you look at the another metric, you look at tenor. I think most dealer books outstanding average life would probably be somewhere 3 to 4 years. You look at LCH, my understanding there is their average life of their cleared population is some 8 years of tenor. So if you start thinking about the variation margin in the context of 8-year average life, that's something to consider. Then if you look at CME and some of your figures, and I'm sure they'll both help me here if I get their figures very, very wrong, but I think in CME's interest rate complex, just thinking of Eurodollars, T-notes, Fed funds, there's some current open interest of some 15 trillion or so, and if you take Fed funds out of that, it's about 11 trillion size market. So a very different size if we're talking about. Then if you look at the tenor, most futures are fairly short dated in maturity. So we're looking at, just think of sort of rolling Eurodollar futures with huge volumes. Most of the volume is in the front contracts, and they mature every 3 months. So the variation margin over the life of 3 months is going to be very different over the variation margin of something that's 8 years. So I think when it's a great benchmarking question to start with, because we start talking about these different models and we defer to, something, we say we defer to the futures model. In a lot of these conversations, these are apples to oranges when we start talking about risk. So, that would be my cut at the broad differences.
Can I ask a question, though, Richie? You're making it sound as if there's a difference in the way the risk posed by the variation margin if something exists for a long period of time or if it exists for a shorter period of time. And with the variation margin being settled every day, I'm not sure I understand the distinction.
Well, I'm just looking over the life. I think that's a fair point, Kim. I mean, I think, first of all, these sheer volumes, we're talking very, very different size markets. And if you're, a lot of these futures that we're talking about in the futures market are very short-dated contracts anyway. So if you look at the daily variation margin of something that has 3 months of duration and, a very small BPV versus an average life contract of 8 years, so a daily, just the daily variation margin alone and the sheer size and the longer duration with a higher BPV, just much larger numbers.
I think, Richard, I would add to that, I agree with your comments already, but I would add to that also the difference in terms of how the products trade, in the sense that a lot of the swaps basically reside in a book for a long time after the initial trade. So it's about the unwind, the unwind aspect of the book is going to be different versus a shorter dated, 3-month future, basically, which is eminently observable. So it requires a longer unwind horizon. and it has to be handled with more care, I guess.
And also the operational needs of margining and doing the computational calculation every day is different on the OTC products. They have longer dated cash flows, they have coupon resets, things like that. So from doing the portfolio calculation every night, which both the FCM and the CCP need to do, it is a more computationally complex instrument.
Also more model-based. Valuation is more model-based. While we build an interest rate curve, all the off-the-runs or anything that's not traded that day is discounted and so on. So there's a model valuation that's separate from a widget price that trades in a central order book. There is no central order book for the swaps.
So it seems that the comments you're making go towards differences in how they could be cleared.
Yeah, right. And also the variation margin is collateral,
right,
which is a rather substantial difference from the futures clearing model where variation margin is daily settlement.
So you're saying the VM is collateral and you don't what is IM then in a OTC trade?
Also collateral, but the VM collateralizes current exposure.
Yeah.
And IM collateralizes potential future exposure is the way we think about it.
I think one of the things that's important to understand is that in the OTC area, in the OTC area, for most of the people on this side of the panel, on the buy side, they don't post what you call in the futures area initial margin, but in the swap area it's called independent amount. And so out of the box, when you go to the cleared side, it's an economic negative. Second, the models exist today, the futures model, the swaps model. Over 90% of global derivatives are done in the OTC swaps market as compared to the exchanges. And people have chose that for a reason. There's a lot more flexibility in the OTC area to establish the types of protections that you want to have with your counterparty. How much you want to be exposed to the risk, how little you want to be exposed to the risk. When it comes to the margin that you post in the futures area, they really don't have much choice. In the OTC area, you can negotiate that, and in addition, you can actually control it, and that has important portfolio management consequences. If I'm holding a bond and I've got a tri-party, that bond is still mine. It's pledged for the benefit of a secured party, but it's still in my portfolio, and I'm getting the income on that bond. And when you look at my assets list, it's going to have that bond. In a futures area, I give up a bond to the FCM. Well, that bond your Treasury could get converted to a grease bond the next day. I don't have the Treasury in my portfolio anymore. And so there are significant differences between the futures and the swaps market, and today the buy side opts for the swaps market model.
And let me try and focus folks a little bit, though, on the distinctions, to the extent there are any, between swaps as they might be cleared and futures. Because one of the points that folks have raised is, wait a minute, we've got a futures model. It works. It's worked for a very, very long time. And so we should then bring swaps into this model that has proven itself. And I guess the question is, are there, in fact, any differences that would challenge that? Or, in fact, is a cleared swap really the same as a cleared future? And maybe that argument has weight.
I think one of the things that we need to pop pretty quickly is the 100-year example. In 87, when the market crashed, the CME, as I understand from people who served on the risk committee during that time, went to get margin from the FCMs, and many of them couldn't post it because they couldn't get it from their banks. And when margin is called, it's called on a T+1 basis from the customer, and on the CME, as we understand it, it could get called that day. We understand that there was pressure put at the government to force the banks to lend to the FCMs. Had they not gotten the capital, we may not be bragging about CCPs today. In fact, one of the CCPs in Hong Kong went under. So, we're talking about a structure that hasn't been tested. it's a bicycle compared to the OTC car, and it's carried the weight of that person, but now you're taking, tons of bodies and trying to put it on the bicycle, and it can't bear it. And what we're saying is that the risk assessments of the CCP need to be rethought in light of the volume.
Can I just maybe come back on that, because it has been tested. We've cleared interest rate swaps as traded in the OTC market, no change to the way they're executed. Richard gave some statistics just to correct him a little bit. We have over 50% of the open notional going through swap clear today. And when Lehman Brothers defaulted, that was a $9 trillion portfolio of interest rate swaps, idiosyncratic, no trade the same, so therefore no profile of risk on each trade the same, so non-standard. There were 66,000 trades. They were out to a maximum maturity of 30 years. They were in 5 different currencies, and we closed all that risk out using in the region of 100, 150 hedge trades in the market, big trades, macro hedges, and then auctioned the portfolio and gave that back to the market. So that was all done well within the margin that we had of Lehman, so nobody was impacted in a mutualized way. Obviously, this is very much dealer-to-dealer centric back then, and we're expanding that model out now to dealer-to-client. But to say these infrastructures haven't been tested is not 100% true. I know Kim mentioned in one of the earlier sessions, one of the reasons we're moving this model into this model is because of the success of the futures model. I'd like to think as well it's maybe something to do with the success of closing out a large OTC derivative portfolio of Lehman as well. So if you take a slice through our portfolio, which it's cleared swaps, we've got about 910,000 trades. When we did a slice through of about 850,000 trades that we had, more than 95% of those trades, if using 8 fields to match, were different. So every single trade is pretty much different that you clear today. So I think that's a fundamental difference between swaps, to answer your question, of swaps and futures. They're not standard, they are different, and they are idiosyncratic. So I think we have to be very cognizant that you can take a swap product, an OTC product, and clear it. But to Jim's point, the risk profile on these, the maturity profile, the way you hedge these is very different to futures. But I'm sure everybody will agree on the DCO side, the risk principles we apply should be the same. It's just maybe the metrics and the models should be slightly different.
And I would agree with the statements about the way that the model has worked and the way that it's been tested. The fact that the Fed flooded the market with liquidity in the crash of '87 is going to have been a fact whether or not there were futures or not. And all of the settlements were met at the CME. There was not a failure by any participant at that time. So, there was that was a test. I think the credit crisis period was a test, certainly on the Lehman side in London where there actually was a default. But I would suggest even on the Lehman side in the U.S. where there was, because of the difference in the bankruptcy structure, the registered entity didn't actually default, but it did operate in a state where it had an impaired parent, and I think that the mechanisms that were in place operated very well to be able to allow customers to manage to a very good outcome in a very stressful time period.
I'd like to sort of repeat the question, but maybe in a little bit more focused way of taking some of the observations that people have made about differences with swaps, and again, taking as a given that we're talking about the subset of swaps that are going to be cleared in the future, and then focus especially on whether these different, or how, if at all, these differences would affect fellow customer risk. Even if there's a greater volume on a transaction by transaction basis, is the fellow customer risk and managing it either from the DCO or customer kind of way going to be the same, or do some of the differences that Dan, for example, has talked about affect this?
I think one of the things on the fellow customer risk is it's just not something we have to deal with today. And, so again, you have the untested aspect to it. On the sell side has a lot more experience on the clearing side. There's been very little cleared by buy side. And so the experience that maybe other people have had and had tested on hasn't really been so on the buy side. We're really not set up to measure the credit aspects of any other customer, let alone all the customers of an FCM. Frankly, we don't feel we have enough tools to measure the risk of our FCM. We don't feel the DCOs have enough tools to measure the risk of the FCM. We think capital is a specious test because you could be levered out the wazoo and have a lot of capital, and we certainly seen that to be the case. We think leverage is hugely important. AIG was highly rated, but highly levered, and none of us knew that. So I think for us, the fellow customer risk just underscores the fact that the buy side just doesn't have the tools or the information to evaluate it.
If I can add on to that, I think this is a key point. And so if you look at both fellow customers and FCM, so we talk about Lehman and the very successful experiences both the CME had with futures and LCH had in cleared swaps. There's not every situation we're going to have CNBC talking to us for weeks in advance, basically saying, move your exposure. That was a unique situation where basically there was a neon sign flashing 24 hours a day saying, you may want to think of moving your exposure. So I don't think we can count on that unless the DCOs themselves are going to establish that neon sign and somehow rate the FCMs and somehow put out a yellow warning or red warning or whatever, because we don't know. We can make our own initial assessment on the health of the FCM, and we do. And we look at capital, we look at other metrics, but it's largely judgmental with not a lot of objective measures in terms of their ability to select clients, their ability to comply with DCO rules. We don't know if you publish, the ratings. It'd be great if there was some sort of rating system. I don't know, I go into a deli in New York and I see this little score there, whether I should buy a sandwich or not. Then on the fellow customer risk, no idea. They're clueless. We are then back to looking at the FCM and the DCO to provide guidance. So we have no idea if there's an amaranth in there, if there's other types of clients, and we have no idea they may be in every FCM. And this is an area of great concern. Where I think that's a risk that we just do not take today in the bilateral swap world. We do not have to worry about it. It's just we can insulate ourselves from it. Full stop. So I do think this is a very key component, and we wrote that in our comment letter that we'd like to see something coming from the DCOs on how they monitor the FCMs and how they and what guidance they can provide clients with.
Well, I think
oh, go ahead.
I was going to say, Richie, I think it's a little bit bigger than any one DCO. There's common membership across all three of us and some entities and other entities, different levels of that. In some point in time, that may need to be a regulator function that's providing that. Your deli analogy, it's not the individual block association that's putting up that sign that says this deli's good. It's the health department in the city of New York. We would like to see that too. Especially as we're evaluating membership and offering new products and soliciting the right group of people to provide that service and the right level of distribution out to customers like yourselves. We also need that type of help, and that's going to require some effort, from this agency and other agencies. And if we think about the holistic view of that, when some of the clearing members are registered banks, or the likelihood that some of them will be or have some affiliate structure with that, and the rules around that, we also need to know what that means on the other side, and what those regulators are thinking. And there's no good place to go to. So even though I could give you an A rating on, FCMA, they may not have A ratings at the other two places, and vice versa. There is no single place to put that, and it's a risk I think we all face in the industry. not just your side of the fence.
I agree with that. You have fellow customer risk, we have fellow CCP risk, I guess. We need to know what the leverage is, the capital is, the risk that they're leveraging and how it's being used, what the liquidity aspect would be on the capital that they've got. We can't see that. We can see what we can see, but we can't see it across the piece. So it's a similar issue that I think the buy side are raising. But in terms of differences between futures and swaps, with reference to the account structure, there's a blend of things. Obviously, the swap product, the OTC product, is longer dated. We could argue all day, but one would argue that longer dated probably has slightly more volatility in price. We could argue about that, but equally, one thing I think we wouldn't argue about is liquidity. And the further out the term structure you go, the further out the maturity profile you go, the less deep the market is, the less liquid the market is. So what does all that mean? It means that in the worst case scenario where we have a default, it's going to be hard to close out that risk. If it's going to be hard to close out that risk, the last thing we want to do is have to close out more than the defaulting entity. In terms of collateral segregation, an LSOC or a full seg model for that matter, so just a segregated model, we have pretty good confidence because we can see the client ID, we can see through to the end client, and we can apportion the collateral in that model. We can safely lift those people and move them to a safe clearing member at that point. So as a DCO, we don't feel necessarily that we're going to have to close out additional risk for somebody who they've not defaulted, they just can't port. And the reason they can't port necessarily is because in today's structure, in the Omni account, we're not going to let people port unless we are confident that we're not going to have to use that client mutualization layer. Whereas under an LSOC model, we can say you can go as fast as you can go rather than as fast as the slowest person.
And just to clarify, so what I'm trying to understand, Dan, is what you're saying there's a difference in liquidity generally between cleared swaps and cleared futures?
I'm saying there's a liquidity difference, and it's harder to close out longer dated risk on swaps than it would be on a standard futures contract where you trade in and out.
It's not so much, it's that the risk is so much bigger. And there's no central order book to put it anyway, but the risk is so much bigger.
I think the biggest difference between the futures and the swaps, first of all, traditionally futures trade in a silo environment. You will see one risk being in one location. Here we will have, most likely we're going to have the same instrument traded at least two CCPs. It's going to make it more difficult for them to actually see for the same shock what is going to be the behavior of the client, how much is the certain client affected. They know that they have exposure to 1 billion of CDS, of an index in CME, but there might be another 1 billion in ICE. They don't know what the impact is going to be. I think when it comes to health, when it comes to assessing the health of the clearing members, the FCMs, I agree with Chris that they don't have the tools to actually do that themselves. At some point, I think we're going to need the regulators to be able to try to conduct some kind of stress test for the existing FCMs to actually assess the health of those FCMs for general shocks in the market.
I think there's a different, I would draw a distinction, I think, between the ability to manage risk at the CCP level or at the regulator level and the ability or efficacy of putting out a rating. I think we all found that the rating services sure put out ratings, but they weren't necessarily as helpful as they might have been relied upon to be. But as far as the risk management, I mean, we do our risk management and in the listed business, and we're set up to do it in the over-the-counter business at the individual customer level. Now, in the futures world, you can't see every customer. You can only see the ones that have 25 contracts or more. So you can only see the ones that are even in, by anybody's definition, marginally material. If you have any kind of a presence in the market, we can see you. We can evaluate the concentration risk that the clearing members have among their customer base, and the CFTC, as a central reporting mechanism, sees that across all of the markets, and I presume we'll see that across all the cleared and probably even the uncleared swaps because of the SDR and the reporting functions that will be in place. So I think there will be an ability for there to be risk management that is performed at that includes each CCP doing it from their own viewpoint, and then the regulator being in a position to do risk management at the overall.
Who is the we you're talking about? Because you're not going to be able to see the unclear transactions that someone else will have. Only the regulator will have access to that.
Right.
Okay.
We each can see our own piece,
Yes.
the DCOs, and the regulator can see the whole picture.
Before we move on to risk management, and we will, I just wanted to wrap up one point I'm trying to understand here. So what I'm hearing is there is greater risk because of perhaps either longer structure, lesser liquidity on the swaps end than the futures end. And I guess the question is, what would the impact of those distinctions be for fellow customer risk?
I mean, I think one of the things you're hearing that there's more risk, but you didn't also mention that there's different risk management that attaches to some of those risks. Those products are margined differently from the way that the simpler structures are margined, and the default management practices that each of us has in place to facilitate the liquidation of the less liquid, less visibly liquid product sets are very different. So that
default management would be post-default.
And it's managed differently as well.
Bob, I think one of the key points here to understand is that when you're talking about collateral, we have transparency right now. So in a tri-party arrangement, there's a third-party record keeper independent of the FCM who gives transparency on the collateral that's been posted by the FCM or the collateral posted by us, our swap dealer, or the collateral posted by us for the benefit of the swap dealer. In the DCO world, what we understand, and I'm glad to stand corrected, is that although the DCOs, and they vary among them in terms of what they can see at the customer level, although they can see margin exposure, they don't see collateral. And so they don't get to see, what I posted to the FCM. They get to see my margin exposure for my contracts. But the DCOs don't have transparency into the collateral. And so there's a key protection that we've got in the OTC area that doesn't really exist in the CCP area, and that is the transparency on the collateral.
But let's focus on that.
And on a day-to-day basis, we don't see the collateral that's in the account of a customer at an FCM, but we do have transparency into the efficacy of the practices of holding margin and holding it in segregated accounts through the financial supervision and audit functions. So there is ongoing monitoring of that, but it isn't a day-by-day view into the balance in the account at any point.
It's a periodic versus a daily reporting that we can get from a third-party bank.
Just to be clear, as I'm understanding what you're saying, Kim, you of course know what they've posted with you.
I know what the FCM has posted to me, and if we live in the LSAC world, I will know. I won't know anything different in an LSAC world than what I know now, because right now I'm margining each account individually. The FCM has enough margin up, so if you allocate it across all the requirements, everybody's got enough margin up, and that's exactly the same thing that I will know in the LSAC model. I won't know that it's actually James's collateral, though.
No, you don't know whose it is, but in other words, you know what you have. Secondly, as I'm understanding it, and I understood this way before, but I want to make, this is what I'm hearing you say now as well, you supervise your members. You don't know every day what they've collected from customers, but on a periodic basis, you look and you see what they've collected, and you evaluate then if they are undertaking from your perspective appropriate risk management.
That's correct.
Well, just distinction between full seg and LSOC. On the full seg, we will not have, if James does a trade or a bunch of trades via an FCM and the margin on those trades is 100, the DCO will not register or clear those trades unless they've got 100 from the FCM. So we will always see that we have 100 against those trades, and if there's somebody else, William next to him, has done 100, we'll see 100 as well, and we'll have 200 in the account. So we will always see the collateral value. The distinction here is that we won't see that James gave the FCM some T-bills and William gave the FCM corporate bonds and did some transformation and passed them through. But we will always see the collateral value of relative to their risk. We will always have that reconciled in the clearinghouse, certainly in the LCH model. The other speak for
that would
themselves.
be true in any model that we would have collateral.
I mean, even in the case that we have today at ICE Trust, where we take gross margin on behalf of clients' trades, and if a clearing member today charges additional margin, or we'll call it excess, so if the clearinghouse is calling, in Dan's example, $100 for that given position, and the clearing member says we need $120 to support that position for whatever the reason and whatever risk management they've decided to put on the customer account, we're collecting all 120 in that. Well, at least 120 is being paid, but to Dan's point, the composition of that 120 and what you may be giving to your clearing member, there's no visibility in that. All we know is that we needed 100. We needed 100. 120 was collected. We're taking that 120, and we're segregating that off and putting that out of harm's way.
So, as I understand it, on a day-to-day basis, you don't have that visibility. Do you have the ability to look at your members on a periodic basis to determine the the quality of the risk management that they have?
We certainly monitor their behavior on a daily basis, and I would say that there are periodic reviews, and certainly, there are times where operational issues around their risk management capabilities are discussed at appropriate levels within the governance structure in our entity. So,
I guess my question would be, did that help in the Lehman situation? Because, the reality is that you can have that periodic oversight, but it didn't stop anybody from allowing Lehman to continue to clear.
How much,
maybe just
on
come
that
back on
score,
that.
how much did you folks lose in Lehman?
0.
One of the things that we're talking about here is what happens with my collateral and what's the risk associated with that. I think we'd all agree that this room can accommodate a certain number of people, and we're all comfortable with that. But as the numbers get bigger, our comfortability goes down. As we talked about at the beginning, the volume that these platforms have had before, all significant in certain cases, has certainly not been the $600 trillion. When I post collateral today, I get to see it, and I get to walk through its transit. That transit risk doesn't get protected, doesn't get covered in the LSOC. It doesn't get covered in the futures model. And so when variation margin comes back and forth, it gets passed around, and there's risk in transit. One of the advantages to the tri-party arrangement, and as was suggested this morning, perhaps adding the DCO to that, is that you don't have that transit risk. And so in a bankruptcy where there's tons of players, much more than we've ever had before, on the clearing experience that people were talking about and praising, and that there was 0, there were very few players on those markets because it was just the dealers. Now we're talking about adding the whole market. And so, albeit it's comfort. Is it complete comfort? Absolutely not. And we would say when we went through Lehman, we had tens of millions of dollars exposure to Lehman. Guess what? We got it because it was in our account with the bank, and it protected us. And what we're saying is, if you're asking me to get out of a car with airbags, seatbelts, side bags, and get into a car without that, I'd say I should have a right to wait until it has it. And so we're suggesting that the optionality model here would address these very collateral and these transit risk and these other risks, and we should just wait till we get that taken care of.
I think, one of the, and I mentioned this towards the end of the last session, I think one of the things that would make the buy side feel more comfortable is greater insight and greater disclosure into the FCMs, as this gentleman at the end of the table said, and it's something that we suggested in a comment letter that we wrote some time ago on this topic. Greater disclosure, and I don't think that, well, I speak for our firm, but I don't believe that many FCMs would have an issue with that.
Well, let me ask about that, because I assume what you're talking about certainly is things about information on your balance sheet.
Well, yeah. What I was thinking is I'd be very interested to hear from this group what information they would find useful, or what they would think would be material information that they're not getting right now.
Well, let me ask this: would the information that you're willing to disclose also include the policies that you have for doing risk management?
Would think so.
And would that also include the exceptions to those policies?
I don't know. I mean, I haven't really considered that. But again, I'd rather hear from this crowd what.
Well, I'll take a shot at that. I think if given the choice between more transparency around our FCM and their policies, and it would have to go beyond that because we'd have to have transparency into who else is in the client pool if we're using the omnibus method. If I had the choice of that versus a full segregation model that would give the certainty around the collateral, I'd choose the latter. Because the former, while it would give you some comfort, the world's a very dynamic place. And those exposures, those financials, those counterparties can change from one day to the next. And I think many of us, you've heard if there's a common theme, we'd really like to have control over our own destiny. That's what we've had in the OTC market. We've been able to choose our OTC counterparties. We've been able to isolate our risk if we choose one counterparty and not another. We know we have no exposure to that counterparty. However, in an omnibus model, we could be exposed to that counterparty in the omnibus pool. So we lose control over our own destiny. And again, I'm sorry to come back to this again, but if we're not given a choice, what we will choose to do in a market that is disrupted, we will back away. We'll pull our capital away, and that will add to the diminishing liquidity in the marketplace that will already be there as a result of the crisis itself.
Yeah, if I could add, and I completely agree with John, if given the two choices, I'd rather not have to make those judgmental calls based on ratings and judgments of those fellow customers. And, as a fiduciary, we would like not to have to make those type of risks. We are hired to make investment risks. If we could standardize this by having, the segregation and take that decision-making away, and then we can focus on, our expertise. That's what we're hired to do. And, so if maybe you're where we end up is forcing more disclosure with FCMs, and then we're going to just have to hire ourselves more credit people to can make those assessments. And we will be forcing you, John, to tell us every time you have an infraction. And we want to know when you have, whatever, the regulators do to sanction you. We will expect that to be disclosed, and we'll want to know all those customers. And that's, we're going down, that sounds to me like going down a path which is unnecessary given the options on the table. And the proposed rule just, negates the need to do all that.
Just to be clear, if you were to do that, would that impose any costs on you?
Absolutely. That's what I said. We'd have to hire all sorts of risk management people. We'd have to be going out doing the same sort of, diligence. Kim was talking before, about soaring audit costs. We'd have to hire whole departments, go out to interview FCMs, monitor change every time there's any change in their balance sheet, look at different customer profiles. I mean, it's just a whole different nature of risk that today we don't have. As you've heard down the aisle here in the bilateral world, we have people that make it's a limited number of counterparties, but we don't have this notion of fellow customer. That's this unknown to us.
I'm not sure. I guess I completely agree with that, because even when you're dealing with a dealer, I mean, that dealer has multiple products, multiple activities, multiple customers. You don't know on the other side of your activity what it's doing necessarily.
But if we're in a tri-party, it's not an issue.
You won't lose your collateral, but I think you'll lose your position.
One of the things that we're missing
So
here
it's
is
not, 6 to 1.
That's a good point. I mean, we keep talking about tri-party as though it's a silver bullet. I mean, all our derivatives counterparties we use tri-party arrangements with. There's still the risk that the position that you have with that dealer moves in your favor while you're trying to replace it, and that you incur costs that way. So this idea that somehow having a tri-party arrangement with one counterparty so totally eliminates your counterparty risk, I think is a little bit disingenuous. It really doesn't. The other thing I'd say is I don't think anyone's suggesting a model for clear derivatives where we do bear fellow customer risk. I thought that was so off the table. So we seem to be spending a lot of time talking about fellow customer risk. I thought what was being proposed here was this LSOC model where that's been eliminated as long as you think it works.
I think no matter where we end up in terms of segregation, I think as an FCM, as Bob suggested, Barclays does agree and would be willing to show our risk management procedures and policies, and we do talk to our buy-side clients about that. One thing we are extremely cautious and will continue to be is the client confidentiality and the NDAs. So this is a big concept that when buy-side firms are looking at FCMs to provide clearing services, we are often, I'm sure my colleagues from the FCMs are asked, who also do you clear for? We have not said any time a specific client that we are providing clearing services for. So if Barclays is providing clearing services for any of the individual firms on the other side of the table, we do not say that, nor would we ever give out any position level information. It is very important to us that in whatever paradigm is set up and how you evaluate from a risk management standpoint, that the buy side and their trades that they've put on that we are servicing remains confidential and does not leak to the market in any side.
And just to be clear, if on the other hand somebody from the clearinghouse came and said, you're our member, we're auditing you, we're reviewing your work, we need to know this kind of information, is that information that they would be able to get?
To be honest, I would have to go to my compliance team and legal team. Just someone showing up and saying, I'm from the CME, I'm from ICE, that would not be enough. Once it was cleared from compliance and we are going to take so much caution on that, I can't tell you. So yes, from a regulatory standpoint, whatever is acceptable to the community is fine, but we will guard our clients' positions with tremendous emphasis.
And we don't tell either. So when we know where people clear, that's very confidential information. And I'm very sympathetic to the fear about the fellow customer risk. But I'm also very sympathetic to the fact that none of you would want your information disclosed. And so there's a balance on the other side. And I think there are probably ways to get some disclosure that would be anonymous and reflective of risk profile without being reflective of exact client mix. But again, I heard both of you loud and clear.
We're not a proponent of that. We're a proponent of the proposed rule.
You'd rather
we don't have to worry about that.
Optional physical segregation.
And just to be clear, Kim, my question is not whether I know you folks don't disclose things, but when either Dale Michaels' people or Ann Bagan's people go in, they do get access to information that cannot, for confidentiality reasons, go to fellow customers. Is that?
Yes.
Just an important distinction to make as well. We do keep talking about the bilateral arrangements, and I think it's been raised, but just to make sure everyone's very clear, you have protection of the collateral you hold there for the P&L on your positions, maybe for your independent amount as well. But then if that broker goes into default, you have replacement cost. That's the difference here that we're talking about with clearing. You do not have to replace your position, and that could have, we've just talked about it, 600 trillion, long-dated, illiquid markets, highly volatile. You do not have to go in the market and replace your risk. That's the insurance you're buying here, rather than anything else.
Let me ask a question about the bilateral arrangements. Jim, you mentioned the tri-party agreement. I think, Richie, you've mentioned that as well. So essentially, if you have a deal, a trade with a dealer, and the dealer asks you for collateral, if I understand you correctly, you put up the collateral, but it goes to a third party who holds it. So the question I have is, legally, how does that party hold it? Does that third party hold it in trust for your counterparty, number one? Number two, if there's a default, or if your counterparty goes bankrupt, you mentioned that in layman you got your money back. How secure is that? In other words, is that purely a contractual right, which a court cannot touch, or is it so secure that in the event of an insolvency, you're very comfortable that the money will come back to you?
So the way the account is set up is when we have collateral to post, the custodian, which is a third party unaffiliated with either one of us, will open up an account in the name of the GM pension plan for the benefit of the dealer. Okay? The collateral that's posted is ours and remains in our title. I mean, we're the legal owners. They're a beneficial owner to the extent we default. But if we don't default, it's still ours. Similarly, if the dealer has to post collateral, the custodian will open up an account that says, X dealer for the benefit of the GM pension plan. In an insolvency of either one of us, which for pension plans is not something that can happen, in the insolvency of the dealer, what happens is that we then have the ability to close out our trades, and under the agreement, subject to bankruptcy law, we're able to pull back that collateral in payment of the amounts owed. And so, yeah, we are very confident that works, and it has been tested, and not just in the Lehman situation, but for other counterparties that have defaulted over the years.
So, and just to add to that, these are control accounts under the UCC. So there's a perfected security interest in the assets held in the account.
By you?
By the secured party.
The secured party. So the secured party has a security interest.
Perfected security interest. They would deliver an